The primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I trade earnings season with confidence and maximize my returns utilizing options. Earnings season is a volatile time. You're going to get lots of movement in both directions, to the upside and to the downside. How do you take advantage of it while minimizing risk? That's really the key. And the key to doing that is to utilize options. And we'll kind of show you the different option strategies that you can utilize during earnings season. So let's take a look at kind of what our expectations for earnings season is heading into Q2. And before we do that, let's take a look at kind of how did Q1 shape up. So EPS ended up growing by about 5.9% year over year. That's considerably higher than the 3.5% that was expected at the beginning of Q1. So the bar was set, I would say, fairly low at the beginning of Q1. So we were able to beat that by a pretty significant margin. Revenue came in at about 4.3% year over year growth versus the 3.5% that was expected at the beginning of the quarter. So, we did end up having a Q1 that was quite positive overall, with both top and bottom line beating analyst expectations. And the S&P 500 responded quite positively to the overall earnings season, which was Q1. You did see a slight increase in terms of margins to 11.8% year over year for the S&P 500 versus the 11.6% that was expected. So overall, we had a pretty decent Q1 earnings season. 89 and 88% of tech and healthcare companies beat their earnings. Those were the two best sectors from a performance perspective, where nearly 9 out of 10 stocks beat analyst expectations, versus energy was the biggest disappointment. 30% of all energy shares missed their earnings expectations. So, and kind of the response from market participants was fairly balanced, certainly not skewed to the upside. Beats gained about 0.9% a day after earnings versus misses were down about 2.8%. So certainly skewed a little bit more to the downside, but a lot more companies beat than miss, which is why we continue to see the S&P 500 continue to gain. Now, going into this quarter, the bar is set substantially higher. As you can see, EPS expected year over year growth is about 8.9%. And as of right now, we have about 5% of the S&P 500, a little over 5% of the S&P 500 has reported earnings already. We're coming in at about 9.3, 9.4% so far growth year over year in terms of EPS. So the bar was set pretty high, and so far, based on early reports, we are slightly above where the bar has been set. Revenue is coming in at about 4.7% higher than last year, which also, like I said, is the bar set quite high. And this is really where the risk lies, in my opinion, because of how high the bar has been set. Misses, are going to likely have some concerns with regards to how big of a decline we might see on misses, but even on beats. And we'll talk about that here in a second. This is some of the more important metrics that I pay attention to going into an earnings season, rather than just what expectations are, but more so how are markets reacting to beats and misses. I think that tells us a lot about how to position, how to take advantage of different opportunities that we see here in the markets going into this earnings season. When we look at the sectors, what we typically look at are revision ratios, meaning where are analysts changing their expectations or their estimates going into the earnings season? Which sectors are they seeing the most positive revisions, and which sectors are seeing the most negative revisions? Because positive revisions reflect an analyst doing their work prior to earnings season and maybe recalculating what their expectations are. And when they revise their expectations higher, that reflects more positive news, more positive expectations, versus negative revisions refer to sectors where there are more analysts revising those estimates lower, right? So a worse outlook. So tech, healthcare, and financials have seen the best revisions ratio. This is where analysts are revising their estimates higher the most in those specific sectors. And we're seeing energy and materials seeing the worst revision ratios right now. So that gives you some sense as far as how analysts are, where they're seeing the most positive versus the most negative outlooks with regards to the individual sectors. Now, the one thing that I do think we need to really kind of pay attention to is the fact that the S&P is now trading at 21 and a half times forward earnings. That's a pretty substantial margin higher than the 10-year average, which sits just under 18 times forward earnings. So this is something to consider because, as these companies trade at these relatively rich valuations, it just simply means that upside is going to be more limited than when valuations are either on average or below average.